Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning, hello and welcome. You're with us on Bazaar Morning Call and we're coming to you as always from the CNBC-TV18 Motilal Oswal studios. I'm Surabhi Upadhyay. With me, Nigel D'Souza and Mangalam Malu. As you can see, we are in full festive fervor, ready to cheer on, irrespective. Markets go up, markets go down. Sometimes it's red, sometimes it's green. But bura na mano, guys, because Holi hai.
You know,
good morning.
The week
Almost.
started with India winning the Champions Trophy, so Burana Mano Kohli hai, and now we end with Burana Mano Holi hai. But you know, be that as it may, markets will do what they do.
Yeah.
Life is nothing without color.
Absolutely.
And we out here, for all our viewers, wish that your life is full of all sorts of color. The red of love, you know, the green of gains, the blue of not always it's good, right? So the blue of sometimes nervousness as well. That's great. Then you have the black to take away all the nazar, the white of peace. That's all we want.
Well, that's right. And there's a long weekend as well coming up. So let's get through with today's trading session and get off to the holy celebrations as well. So spend time with the family and lots of love to all of you. But Surabhi, you started off overnight cues not looking too bad. We got a markets to get through, and then in fact we get to the celebrations. So let's get straight to that.
Absolutely, and I think the celebrations have kind of begun because, frankly, I mean, in a week like this, which has been such a hectic, crazy roller coaster in terms of headlines, local, global tariffs, at the end of it all, we managed to consolidate. We managed to hold our own ground, and that's not a bad thing at all, one would have to say. Now, overnight cues, very, very quickly, there is some pullback in US equities as well. Yesterday, it was a little mixed on Wall Street, but nonetheless, you had the Nasdaq moving higher, the S&P 500 moving higher. The Dow still ended with a mild red. Now, why is that? Two reasons. One, because those beaten down tech stocks, they're getting snapped up big time. And that again kept the bid going on the NASDAQ. So, you know, you had names like Meta, AMD, Nvidia. All of these stocks were up anywhere between 2 and 7%. Then Intel was surging higher. It was actually up 11-12% in after-hours trading. And that's because Intel is going through a management change. They've got a new CEO. The street seems to be happy with what he can bring to the table and maybe just come up with a turnaround strategy. Not just that, on the macro front, the good news came in the form of inflation. There was so much worry going into this consumer inflation number in the US because of all the stagflation worries. Well, for what it's worth, at least the latest print, the February print, is lower than estimates. So up 0.2% month on month, the estimate was 0.3%, up 2.8% year on year, the estimate was 2.9%. And the markets heaved a sigh of relief, both on the equity front and even on the dollar. And the yields. Speaking of the yields, there was actually a bit of an inch up on the US 10-year and the 2-year. Now, you'd wonder why. That's because this was just basically a bit of risk coming back in the market. Risk aversion had driven down US yields, the 10-year yield to 4.1% earlier this week. But now as things are looking a little better, the market's finding its feet, the stagflation fears are at least receding for now. The yield was moving slightly higher. In fact, the dollar managed to find its feet as well. Dollar slightly above. I mean, the dollar index at that level, it's still very much range-bound between 103.6 to 103.7. But if you're looking at it from an individual currency perspective, then finally the dollar had some respite against both the yen and the euro. These two currencies have been surging through the week. Yesterday, the dollar managed to gain about 0.3% versus the euro, managed to gain about 0.2% versus the yen as well. The dollar-yen, remember, the euro-yen, the euro-dollar equation went up to 1.09 earlier this week. Now the euro has cooled off. It's come down below that level. So that's on the currencies front. But all is not really well on the tariff front. So while we're very excited about the good news and the celebrations, let's keep our eye on the ball as well, because that tariff news is still coming in. Retaliatory tariffs have now come in from Canada as well as the EU. Canada is talking about $20 billion in terms of retaliatory tariffs on US. The Eurozone yesterday spoke about $28 billion in terms of retaliation. So those tariff headlines, well, they've just paused, but it's never over, so to speak. But anyway, we'll take it for what it's worth. Good news back here for us in India as well. We've got a macro bonanza lined up in the form of lower consumer inflation and higher IIP. Consumer inflation is at a 7-month low. IIP is at an 8-month high. And consumer inflation has fallen, with food inflation finally falling, which is great news, which is where the stickiness really was. And on IIP, manufacturing is looking much better, 5.5% on manufacturing. That's the kind of growth, and we haven't seen that in a while. And we'll get you more on this data as we go along. So good news coming in on the macros over here. Like I was saying, I mean, in the midst of all of this, the market's done okay this week. It's consolidated. The Nifty is down barely 0.3%. Midcap index has fallen a little more, 1.4%. But we managed to hold our ground, which is why I am watching out for whether the market today decides to get into holy color and whether that color can indeed be green. We have good news on the flows front as well. FPI flows, we'll talk more about that. But as I see it, guys, it's been looking good today. Global cues, local cues, and that good feeling as you're getting into the long, holy weekend.
Well, that's right. And a couple of factors that have also played out. The SIP number wasn't too bad. It held steady at around 26,000 crores. And also, when you come back next week, I won't be coming back because I'm on a vacation. But next week, those advanced tax payment numbers will also be out of the way. Normally, the first half of March, you see some kind of pressure because the advanced taxes as well do get paid. So that as well will be out of the way. So taking stock of things, the economic data, as you mentioned, is fairly good. The question is, can the Nifty go ahead and conquer that crucial 22,700 mark, which is importantly the resistance mark that we are looking at. So economic data, both on the domestic front as well as on the global front, at least as of now, looks pretty good with inflation very much in control. Overnight, the cues as well pretty good. Brent crude price as well, BF dollar index, the yields as well, no worries on the troika. So that gets a thumbs up. What did the FIs do in yesterday's trading session? Well, on index futures, they added some shorts. So the swing factor closed around 4,000 contracts approximately because they added shorts and they unwound some longs. The net short positions continue at around 82% or thereabouts. And in absolute terms, the FIs, they are net short, close to around 1.8 lakh contracts over there, with the swing factor of close to around 4,000 net short contracts were added, while the clients, they added 4,000 net long contracts in yesterday's trading session. That's why it moved from around that 1.38 lakh to around 1.43 lakh odd. But the FI action in stock futures as well is something that you should keep an eye out on, because they sold in the cash market, that's correct, but they are also buying stock futures. It appears there's a bit of an arbitrage that's going place, and if you look at it in contract terms as well, they added more long positions, close to around 4 long positions on stock futures for every 1 short position as well. So selectively, there are a couple of stocks out there that are going to do well irrespective of what the headline index does. Moving to the options data, today, remember, is the weekly expiry. So options data becomes very important. 22,550 call, 22,600 call, both of them were fairly active in yesterday's trading session, which brings us to the levels. The important mark on the upside, what we're looking at, the 20 DMA, that's at around 22,619. Yesterday's high is important. So this becomes the crucial resistance zone that you're looking at, 22,570 to around 22,620. While on the downside, yesterday's low becomes a reference point. Last couple of trading sessions, we have gone to around 22,300 and bounced off that. So that's going to be important. Since the dollar index is softer, the fears of stagflation have cooled off a little bit from the United States. And you have, economic data that's looking pretty okay, at least the cues that we have. The IT index has got smacked. That's seen a big correction from the top. Yesterday as well, it was under pressure. The Nasdaq did well. I'll keep an eye on the IT index, whether or not it can bounce back today. And since the dollar index is softer and, most metal prices are higher, I'll keep an eye out on both these two. Global facing themes, keep an eye out on both these two. But the Nifty Bank will have to do bulk of the hard work to take us higher from here on. Let's see whether or not 22,700 can get conquered. Mangala.
Well, for me, the most important thing is what are the bulls doing from lower levels? Yeah. And 2 data points really stand out. The fact that over the last 2 trading sessions, we've seen recovery from the lows. How much was the recovery? 150 to 180 odd points. If you look at, March 11th, the low on the Nifty, 22,315. From there, we closed about 183 points higher. Yesterday, the low on the Nifty, 22,329 thereabouts. We recovered about 141 points from that. And both the days, we had factors that dragged the market down. On day 1, we had the weakness that came in from Nifty Bank, led by IndusInd Bank. And then yesterday, it was the IT index that dragged the index. And both these indices will be in focus today. Why is that? Because overnight, we saw the recovery in Nasdaq, so IT stands supported. Secondly, the double delight that came from the macro front. Lata will talk about that, lower than expected inflation, better than expected growth. That should support the banking index as well. So both these factors will work well for the market. And as a result of which, let's see, the GIFT Nifty is indicating a positive start up to 50 odd points. Can we build onto that or not would be the big question. No real worries coming in from Wall Street, minus the slight dip that we saw on Dow Jones itself. And then the other part is, when there is no worry coming in, is there fear which is taken off? Yes, the CBOE VIX was down about 10% overnight. So that's another positive. And the next week, there is the Fed meet, and out there, no rate cut is expected. In there, the commentary will be extremely crucial to track. Back home itself, the FI sold in cash market, 1627 crores. We're used to seeing 2,500, 2,800, 3,000 crore worth selling by the FIs. So 1627 crores, we can totally manage. No real worries about there as well. And then we have the weekly options expiry. Yes, it is a Thursday. Tomorrow's a Friday. It's a long weekend. It feels like a Friday today, but don't lose sight of the fact that there is the weekly options expiry. Option writers are positioned for a 22,325 to 22,585 sort of broad range. When the lows on the market are protected, typically the indices that rally the most are the broader market stocks. Over the last 2-3 trading sessions, the mid-cap and the small-cap indices have been underperforming. But all things working in favor of the market when it comes to recovery from the lows, can we see an outperformance from the mid and small cap index? Can we see better advanced decline ratio than what we've been seeing over the last couple of trading sessions? Is something that I'll be tracking very closely.
Absolutely, Abhin. And the fact that we've got good local news, that should really cheer sentiment today, because a lot of this correction was triggered by local slowdown, not just the international headlines on tariffs. So let's actually address that good news. Like we've been telling you, February CPI inflation has come in 3.61%, which is a lot lower than the poll. Our CNBC-TV18 poll was 3.85%. And the January IIP data has come in higher than expectations at about 5%. We have Lata joining in to dive a little deeper into all the goodness. Lata, good morning.
Well, what is good about the inflation numbers is that for 2 months in a row, we are coming in lower than expected. While this month, February, it is 3.6 compared to 3.85 expectation. In January as well, the expectation was 4.5. It came at 4.26. Likewise, food inflation, which has been the bugbear, up until December, for the previous 18 months, inflation was running between 8 and 11%. January, it fell to 6, from that 8% levels. And now the expectation was 4%, and we get 3.75. So there is something systemic or structural, one feels, about the way in which inflation is consistently coming lower than expectation. Now, of course, CPI is at, headline is at 7-month low, but food inflation is at multi-year. It's like some 3-year low. And the only two elements that are really worrying in the entire food basket are fruit, which is about 14%, and edible oils, which are higher because tariffs were raised on them. Otherwise, all other major food items, cereals, pulses, milk, meat, eggs, just about everything, and vegetables are in low single digit or even negative in some cases. So that does look like there is something structural about this food inflation falling. Only core inflation has gone up by 30 basis from 3.7 to 4%, but that's largely because of gold and not because of metals or something which will work its way into higher prices. So the consensus among economists, they've all moved to now 3 rate cuts. 1 already done, 2 more to come. Until now, there were people who believed that there'll be only 2 cuts. So clearly now 5.75 is the repo rate that people are talking about. And one more thing. By the time we come to May, already the Reserve Bank is giving a lot of liquidity. By the time we come to May, there is a huge 2.5 lakh to 3 lakh crore dividend that will come from the Reserve Bank. So, we can guess whether the stance will change. Why would you keep it neutral? It is accommodative when there's so much liquidity. So maybe in April, you will also get a stance change. Things are very cheerful in the bond market. And now, of course, let's come to the growth numbers. As you all have pointed out, the IIP coming in at 5 is so much higher than the 3.5% which our poll threw up. But much more than that, compare this 5 to the April-January number. That is 4.2, average of the last 8 months. So, last 10 months. So that itself shows that there seems to be a systemic jump. And of course, within that, manufacturing 5.5. Again, April-January average is 4.2. So is this a systemic shift? Is this a structural shift? Is, a hint, that is a question that we can ask ourselves. Capital goods, infrastructure, consumer durables, all of them are 7% or higher than 7% within the manufacturing basket. So this is a great set of numbers. It's only consumer non-durables which has contracted. That's a spot of bother. So all told, there is reason to believe that the good cheer may continue unless, of course, global headwinds are too much.
Right, Lata, thank you so much for that. You bring us double delight out here, lower than expected inflation, better than expected growth. Will that reflect in the markets as well or not? Let's get you an equity call. We have one coming in from Venugopal Gare of Bernstein, who says that one would think that given the significant corrections over half the basket, should be a screaming buy, but the reality isn't quite so. He says they fail to spot a broader buy opportunity in the market currently, which may only arise around a second half macro recovery once more stocks settle. He says if one were to consider broader sectors, only power and large cap IT seem reasonable. He says they remain selective buyers in the large cap names, but small and mid caps still look costly and await further settling before they can upgrade their selective buy call. So cautiously optimistic, selective is the mood from Bernstein.
Yeah, absolutely. They've been one of the biggest bears, and I mean, rightly so. They called it well in time as well, but they've been very cautious in the Indian market. So selectively getting a little optimistic now, it seems. Well, let's quickly move on from India's macro data. Let's go back and talk about those US CPI numbers, which did, of course, offer a lot of relief to the street back there as well. James Knightley, Chief International Economist at ING, is with us now for some perspective. James, good morning. Great to have you on the show. Thanks for joining in. So I don't know, I mean, if this is a permanent relief or just a temporary relief, because the market has been roiled on these recession or stagflation fears, right? But at least the February data was all right. But then all the tariff and the counter tariffs and the retaliation, all that hasn't yet kicked in, you know, at the ground level. So is the market's optimism on yesterday's inflation print, is it well placed?
Yeah, I'd characterize it as a bit of temporary relief. I think, you know, the market had gone in expecting another relatively hot inflation print, but we got this 0.2, and that's, you know, what we really need to track out each month to deliver the Federal Reserve's target of 2% year-on-year inflation. We need consistent 0.2s. So a good number, but when we looked at the details, we saw that it was primarily or overwhelmingly due to a substantial 4% month-on-month drop in airline fares. Most other components still remain relatively sticky. So, yep, good number, but still a little bit of caution in terms of the outlook. And this is, of course, as you state, before we really see the impact from tariffs, because I think the Federal Reserve will be a little bit cautious because their own beige book, their own anecdotal survey of the state of the US economy reported that manufacturers and retailers themselves were also preemptively starting to raise prices ahead of tariffs kicking in. And we also had evidence yesterday, or 2 days ago actually, from the small business sector, where we had a 10 percentage point jump in the proportion of small businesses already raising prices. Just because, of course, you know, if you're doing long-term contracts, you've got to account for the risk that tariffs do kick in and put up your input costs.
All right. Hi, James. Good morning. Good to see you in. What does this mean for the Fed? The Fed futures are suggesting now that we could possibly get 3 rate cuts in this year. Do you think that's far-fetched? How many would you believe realistically? I recall when we chatted last, I think you were hinting that the first half of the year you're not seeing cuts. Maybe there could be some kind of probability we see some later in the year. What are you working with for 2025?
Yeah, I think that's still valid. I think, you know, the expectation was at the start of this year that the economy was in a pretty good place and Donald Trump would come in and perhaps turbocharge that growth story with tax cuts and deregulation. Of course, he's not done that. He's actually introduced significant government austerity, i.e. government spending cuts, the people being laid off, etc., people losing their jobs. And also, of course, introduced this trade protectionism, which is causing some discomfort amongst both households and the corporate sector. Households are worried about higher prices. Companies are worried about squeezed profit margins from the higher input costs. So that is a headwind that's created more concern about the growth outlook. And while, yes, tariffs can cause near-term inflation, there is concern that downside risks to growth could depress inflation over the longer term. And that's really what the Fed is looking at. The Fed can't change inflation month to month, you know, in the near term, but it can have an influence over the medium to longer term. So this growing concern that government austerity, trade tariffs can depress US economic activity is forcing or pushing the market in the direction of thinking, well, the Fed might need to do a little bit more. I would agree with that, but in the near term, we've still got an economy that's growing, we've still got an economy that's adding jobs, and inflation is still above target. So I stick to the view that we won't see anything before midsummer, late summer perhaps, but yes, I think we will see rate cuts in the second half of this year, and we're looking for September and December, with a third cut coming through in March next year.
All right, so 2 cuts this year is what you are expecting. The third one comes in March next year itself. James, you know, I just wanted to understand the other macro data point that came yesterday, and it is not inflation, this is the federal budget that was announced, and alongside that we had the deficit in the US, which topped $1 trillion for the first time ever. With the Department of Government Efficiency, DOGE, coming in and all of that, with all that the Trump administration is doing, do you see this number coming down? If yes, by how much?
Yeah, it just highlights how much work they've got to do if they really do want to bring that deficit down. I mean, we're running a deficit in the United States of nearly 7% of GDP. That should not be happening when the economy is in such a good position. So it does highlight that there is scope for some significant cuts, and we think that those will continue. But it's going to be, as I say, as this data proves, it's going to be very, very tough. So what does it mean for markets? Well, I think there are lingering concerns about debt sustainability in the United States. And in an environment where the US is, with its robust viewpoints on trade and other things, geopolitics as well, is upsetting and alienating many other foreign countries. And we've got a key question: will foreigners keep buying US treasuries to the same extent that they have been? Will it put more pressure on domestic investors to step up and buy these treasury bonds to fund the US deficit? And if that is the case, then we could see buyers basically saying, well, we need more reward for the risk that we're running. And we do think that that does threaten higher treasury yields over the medium to longer term. So we'd still be looking for treasury yields, the 10-year treasury yield, for example, which has risen back up to about 4.3%, to push higher. We'd be targeting 4.5% in the near term, with the risks that we do on these debt sustainability concerns approach 5% at some point.
Oh, very, very interesting. And we're looking at big shifts, right? Big shifts in market behavior, investor behavior as well, all triggered by these tariffs. Thank you very much, James, for the perspective this morning. Really appreciate you being with us on the show. Well, let's move on now and tell you about what more is lined up on the show. Lots coming up at 8:35. We'll have the management of Happiest Minds Technologies joining in. We, of course, saw a big sell-off in tech stocks yesterday. So is there a valid concern about perhaps a bit of a growth scare in the US? How is Happiest Minds looking at its business in this landscape? That's what we discuss. At 9 o'clock, Vishal Manchanda of Systematics Group joins in to talk about some of the key trends in the pharma sector. Nilesh Shah of Envision Capital is our market master of the day. He joins in at 9:20. At 9:30, we'll be speaking with the management of Aster DM Healthcare to talk about the reduction in promoter pledges from 99% to 41% in the company. Following that, Karan Gupta of India Ratings and Research, along with Abhizar Divanji of NeoStrat Advisors, join in to talk about IndusInd Bank's derivatives portfolio debacle, the investor concerns, and whether that confidence can be rebuilt. At 9:50, Arun Shukla of JK Lakshmi Cement joins in to talk about demand pricing trends. And towards the end of the show, in our special segment Indianomics, Lata will be in conversation with D. Subbarao, former governor of the Reserve Bank of India. All right, let's take a quick break on that note. We'll come back and focus on some important stocks and news on the other side.
You're watching us here on Bazaar Morning Call on CNBC-TV18. The GIFT Nifty indicating a positive start for our markets. Good cues coming in overnight from Wall Street, and macro data positive as well. So let's get micro then. A bunch of stocks on our radar this Thursday morning, which feels like a Friday because it's a long weekend. Sudarshan joins in with all the stocks that are in the news. Sudarshan.
Good morning, Mangalam. So we'll start with BL, which has received new order of rupees 2,463 crore. With this, Q4 order inflows stand at 7,200 crore. And for FY25, order inflows are at rupees 17,000 crore versus company's FY25 guidance of rupees 25,000 crore. And Nomura believes company is on track to meet the order inflow guidance that it has given for FY25. Second is Polycab. It has executed the agreement with BSNL, that is for a BharatNet project, and that is valued at around rupees 3,000 crore. For Coromandel International, it has announced an acquisition of NACL Industries, which manufactures and sells crop protection technicals and formulations. So first, it will acquire 53% stake from promoter, and second, also it has made open offer to acquire up to 26% stake from public shareholders. But the interesting part, look at the NACL Industries stock. Yesterday it was up 12%, and in last 1 month the stock has moved 41% higher. Next is Jubilant Pharma. One of its units in the US has got EIR and VIS status from US FDA. What does EIR mean? It means that US FDA has closed the inspection, but also company has informed that this unit had already stopped manufacturing any product. In future also, this unit will not manufacture any products. Last is Muthoot Finance. Muthoot Insurance Brokers has informed company regarding a fraud which has been committed by Muthoot Insurance Brokers CEO, who is already suspended, and one of the ex-employees of Muthoot Finance, and the amount is of rupees 12 crore, and it's done between April 2023 to November 2024.
Okay, all right. Thanks a lot for that. Sir, looking as sharp as ever as well this morning. Well, let's hop across to Manisha. She's joining in to tell us what's all the action from the commodity space. Morning, Manisha. Things looking better out there.
Oh, well, absolutely, yes. I'll start with the crude oil prices because we're looking at 2% of gains overnight. And with that, we are back above $71 a barrel for the Brent crude prices. Well, all the U.S. data, whether it was about inflation, which has slowed down, and the strong domestic demand seem to be supporting the crude oil prices. Also, the gasoline inventories fell in U.S. by 6 million barrels. So that tells you that the demand clearly seems to be coming back. But of course, it is going to be about the ongoing tariff war, the weak China demand that would keep many of these prices in check. But like crude, other metals also saw some gains. So we had copper prices gaining 1.5% overnight. Silver gained 1.5% as well. Also supporting all of these commodities is the dollar index, which is trading at a 5-month lows right now. So when continuing in metals, you had zinc prices, which are trading at a 2-month highs right now. Lead gained quite strongly. That one is trading at a 13-week highs. Aluminum is trading near 9-month highs as well. So is the case with copper, very close to its 9-month highs. So we are looking at strong support coming back in many of these commodities.
All right, strong support coming in many of these commodities. These prices doing extremely well overnight. Contained dollar index as well. We'll keep an eye out on the commodity prices and the impact that they have on the listed markets as well. We'll take a short break, come back on the other side. Dipan Mehta, who's the director at Elixir Equities, joins in for some fundamental stock talk.
Welcome back. You're tuned in to Bazaar Morning Call and hope you're having a good morning. Well, we have run you through all the stocks that we're tracking today. Let's get some more fundamental analysis going. We have Dipan Mehta, Director at Elixir Equities, who joins us on the show. Dipan's not yet in his holy outfit, but tomorrow I'm sure he's going to be a lot more colorful. Hi, Dipan. Good morning. Good to see you in, and happy festivities in advance. It's a long weekend, a lot of color. Hopefully the color is green today. Let's talk about a couple of stocks, though. Yesterday, the problem was on tech. A couple of brokerages came out there and they said, hey, watch out. The growth that you all were expecting in FY26, it isn't going to be that good. Morgan as well as Motilal, both of them did point that out. What do you think? The index itself, I think, is corrected close to 20% from the top. But a couple of stocks yesterday, I recall Coforge, from the lows of the day, there was some buying. Your approach to tech and what do you like from here?
Yeah, Nigel, good morning and thank you for having me on your show, and happy Holi to you, entire CNBC team and all your viewers. Looking forward to at least a holiday, if not celebrating Holi actually. But coming specifically to your question, yes, I think that the chances of US going into recession are increasing, and that doesn't spell good news for Indian tech sector. In any case, I think one has to be extremely selective when it comes to software companies. And there are only a handful of companies, 3 or 4, which are able to sustain the kind of 15% thereabout growth rates, which is the bare minimum required for an investor to consider a stock. So by and large, I think investors should remain underweight on the technology front. And if Trump makes any changes in policies regarding this particular industry, then that will sour the sentiment even further. So I think it's time to be underweight tech, at least large cap tech, which has gone nowhere in the last 5-7 years or so. They have got stagnant growth rates if you remove the kind of rupee depreciation benefit which they have got. So from that point of view, I think one is to be underweight tech.
What about banks, Dipan? We are seeing some positive movement in the Indian macros. The inflation is cooling off faster than people expected. The growth is coming back. We don't know whether it's structural yet or not. Both these are positive from a bank standpoint. Would you look at building up positions in banks now?
Good morning, Mangalam. Sorry. Yes, of course. I don't think it's structural, but we are going to see a cyclical up move in the entire bank and BFC sector. And of course, we are quite positive on banks in the medium term, short to medium term as well. There's a good trading rally. And I think March and June quarters also will have the benefit of base effect. But the best bang for the money will come in NBFCs. And that sector also has been underperforming, I think, right from October 23 onwards or so. And these companies will benefit not only from increased liquidity, but the risk weightages which were changed by RBI, that also will ensure higher credit flow to the NBFC sector. And there are a lot of aggressive managements over there. Their collection efficiencies also may improve. So very positive on the NBFC space, more than the banks also. And I think one should go for those diversified lenders, be it Bajaj Finance, L&T Finance, and some of these companies which are into many products, not just single product like maybe just vehicle finance or housing loans.
All right, Deepan, we'd request you to stay on because you spoke about tech, large cap tech in particular, that you would be underweight because of US recession and stagflation worries. Let's get into management. You might want to listen to this one as well. What kind of hit it could have for the IT sector, or could we be resilient? We have Happiest Minds joining in. Venkatraman Narayanan, who's the MD and CFO of the company, joins in. Along with him is Joseph Anantaraju, who's the Executive Vice Chairman and CEO of the Product and Digital Engineering Services of the company as well. Thanks a lot, gentlemen, for joining in. Season's greetings to you all as well. Venkat, let's start with you. You know, the street is worried about US recession. They worry that stagflation will hurt. You were optimistic after the third quarter. You said that demand environment is a lot better than what the street was fearing. Now that, we're in the middle of the fourth quarter, what's your sense and what kind of growth can you report this year?
Yeah, good morning and happy festival wishes to all viewers and you. Yes, we are reasonably upbeat about our performance or outlook as it stands right now. We are currently in our planning phase. Our teams are working with the clients and customers on renewals and budgets for the next year. What's coming in is, I would say positive, but obviously colored slightly by the fears of recession and maybe some part of the stagflation that you mentioned in the US. US happens to be our largest geography, and so we need to be keeping our ears very close to the ground on the happenings in the US. And things are happening at a fast pace under the current dispensation, whether it is on tariffs or support to USAID and other organizations. And today you must have read what's happening to the cuts in the education sector that are being affected by the dispensation. So to that extent, yes, things are kind of colored. We are just coming out of a year where we have shown very good or decent growth, and looking forward to a similar kind of a growth.
So would you end this year? Would you end this year with 30% growth as you had earlier aspired to? Because the first 9 months are 25%. Now things are looking a little colored. And what are the clients doing? Are they renewing? All your renewals for this year, have they been done?
I had already mentioned that this year, while we have not given a guidance of 30%, we said 30 to 35% as a forecast. The lower end of 30% is looking difficult, but we have not, changed the forecast as of now, given the way things were panning out. And, we have a certain amount of revenues coming in from Artha banking, which is kind of lumpy. So without knowing exact contours of how that is, we said we'll hold on to 30%, but 30% is looking a little bit of a challenge. That's what we said end of Q3, and we continue to say that as well. Don't want to talk more than that because we never gave a guidance of anything in terms of top line other than, a broad forecast of 30 to 35%. But going into the next year, I was just talking about the next year growth. We are calibrating all the information that's coming in. Today, we are a much larger company thanks to the acquisition of Pure Software Aureus, and we have also acquired customers from Gabs in the Middle East. So, there are quite a bit of work that's happening to ensure that we get all the numbers together. renewals that were the large renewals that were to happen. Many of them are in an advanced stage of closing, either way with the customers. So things are progressing as normally they are, but the only I would say is about.
Venkat, allow us to understand this. You're saying that that 30% objective of growth, 30% looks a little challenging. We're just trying to understand whether it's because of slower decision making of your US clients, which means that some of this uncertainty on macros, tariffs, US growth, that starts showing up, that has started showing up. So are you saying 30% growth in FY25 is a challenge because of Q4 decision making slowing down in the US? Or is it looking like a challenge because there's a delay in final deal closures, and maybe instead of Q4, those deals are booked in Q1? So then it's just a matter of a couple of additional weeks, which falls into a different month. Which one is it?
It's mainly on account of two things. When we started the year, we thought we'll get the entire year from a consolidation standpoint from both the companies of Pure Software and Aureus. While the closing happened early April, by the time we could get into the consolidation phase, we lost about 1.5 months. So that was one reason that affected us, and that's about set us back by close to $10 million, $7 or $8 million. The second thing was obviously, we have taken on Artha Banking, which is a product business which comes along with Pure Software. It's doing reasonably well, but it tends to be lumpy. And we did caution the market that there are deals in Q4 which needs to be closed, and which are in advanced stages of closing. One doesn't really know how it can go. This is the second numbers that we had talked about, because it was an acquisition. While we know the services business very well, the product business has its own rhythm, and we are coming to speed with that business.
No, so the sense, Venkat, that I get is that whatever small or little shortfall that you have on your 30% target, that's more a nature of perhaps some delays in getting consolidation going of earlier acquisitions, some delays in deals. It doesn't seem to be linked. It doesn't seem to be linked to the here and now. So now, if you can expand on that, going forward in the last, say, 4 weeks or so, 4 or 5 weeks, what is client commentary sounding like? Are clients more cautious? The fear on the street is that the recovery in discretionary spends that everybody was hoping for and penciling in, that could be hit because of this new environment in the US. So are your clients giving you that hit?
Joseph would be the right person because he's in the...
Joseph,
Let me take
please.
that. Let me take that, Suvi. So I think, I've been on the road the last 6 weeks, literally, and both in UK and in US. And in US, what I'm hearing from, obviously, as you would have seen, there are quite a few, changes, uncertainty, announcements happening at regular intervals. So customers are keeping a close watch on how things are evolving. And, all the conversations that I had with customers, nobody has taken any action so far in terms of looking at hunkering down or cutting. And I think the expectation and hope is that in another 4 to 6 weeks, once all the back and forth is done, you'll get more certainty and things will settle down. I think that's what the expectation is. The renewals cycle that we had started in December, by and large, most of it has got completed. I think the only area where probably we took a close look at is a couple of customers that had a little bit more dependency on funding from the government, and we've been a little cautious in the way we've approached it and the way we planned. There's also a third element to this that customers are looking at this as if we need to really optimize on cost driven by the overall broader macroeconomic factors, work still needs to get done, right? The projects are started. And what I'm seeing is there's at least an inclination or customers looking at how do you get more for the same amount of dollars. And I think that in some cases will give us an opportunity in terms of being able to get some work out to India, more offshoring. So I look at it as, as an opportunity, and if we can identify the type of customers that would have to do this, we should be able to turn this, whatever I'm seeing in the news and elsewhere, into an opportunity.
Okay. All right. Things a little bit gloomy or a little bit muddled in the near term, but let's get a longer term closing comment from you, gentlemen. Could you tell us that $1 billion target that you'll had, I think, by 2031, do you think that will need some tweaks? Point number one. Point number two is, what is the targeted margin band on a longer term horizon? For a variety of reasons, it's come down from around the 22%, closer on 17, 18% odd. Should we be working with this band?
I'll take the question on the margin band. Yes, EBITDA has been between 20 to 22%, and operating margin has been at the 18% number that we were talking about. We are looking at maintaining that sort of a number for going into the next year as of now. The only point that I've been referring to is the investments that we are planning to make in Artha Banking, because we need to make that. There's a little bit of investment that we need to make it usable for the Indian banking sector, which is bustling, and also Middle East, where there is quite a bit of demand for digital transformation, the BFSI sector. The second is, there is a little bit of investment that continues to grow into the generative AI business, GBS business that we have been doing. Between the two of them, last year generative AI, or this current year, we should end up spending between $2.5 to $3 million. And Artha Banking would be a similar number going into next year. And these are the two numbers that we are keeping a close track on, and making sure that they pay off for themselves either in the immediate year or the future years.
And what about the margins?
The margins, we are hopeful of maintaining in the similar kind of,
so
range.
18% approximately, right?
That's right. That's right.
And billion
we'll
dollars?
come back to it. We are currently in our planning phase. We'll come back to that because, we need to work out the final numbers. But as of now, we're trying to maintain that number in terms of margins. Yeah,
okay. All right. A little short on time, gentlemen, but thanks a lot for giving us some color. We look forward to having a chat with you all at the end of this fiscal when you'll report your Q4 numbers. Wishing you all a happy Holi in advance and all the best for the remainder of this year. And
Happy Holi.
in the next
Thank you.
month.
Bye-bye.
Thanks.
Same to you and Team CNBC.
Thanks. Bye-bye. Thank you.
Thank you so much. Thanks for joining in. Well, time to slip into a short break. Up next, our technical experts will join us. Sudarshan and Mitesh are waiting to give us their call.
Welcome back. So just 10 minutes to go before we start getting our pre-open rates. Good time to look at the technical setup of the market. That's the implied open, suggesting that the color to begin the day as we're getting into Holi mood is going to be green. Well, we have Sudarshan Sukhani as well as Mitesh with us now. Gentlemen, good morning. First of all, best wishes of Holi to both of you. We wish we could add some color to those, very, very professional looking crisp shirts that you're wearing. But I think we'll get to it by the end of the day. Let's talk about the overall picture, Mitesh. The cues are very positive, local and global today. What's the call on the index?
Yeah. Good morning and Holi wishes to you and the entire CNBC family, including the viewers. The market, has been resilient after that bounce back. So once the Nifty kind of tested lows below 22,000, bounced back to about 22,670 odd levels, and then in this decline, post that bounce back, we are repeatedly holding that 22,300 mark. So that becomes the first support pivot, and I've been highlighting that as well. And in the short term, looks like a range of 22,300 to about 22,650. But the way the indicators are shaping up, coming out of oversold levels, trying to turn northward, good chance that we might try and see the index make an attempt beyond these levels and head towards 22,800. Above which, of course, then the trend in the short term will turn positive. So these are the levels to watch out for. The idea should be that try to buy around 22,350, 300 zones and take profits around 22,600, 650 levels. In case we cross that, then we look at further locks.
Okay, all right, in a bit of a range, look to buy the drip and in fact take off some money around 22,650 and then, fresh call will come in. Got it, Mitesh. Sudarshan, what about you? Hope the throat is better. Some good amount of hot tea has been had. Tell us, what's your call on the Nifty?
Good morning and best wishes for Holi to all of you and the viewers. I think the Nifty is giving us the signs of a short-term uptrend. See, we bounce back and try to test lows, and every time we do that, we make higher lows. That tells us that the market is willing to buy higher, and that's good news. Now, I would be a buyer on dip, and I don't expect a sharp intraday dip today. It would be a mild dip, and that mild dip is a buying opportunity. The problem is somewhere else. The problem is that we are entering into an extended weekend. And do you want to carry positions over the weekend? That's a decision individual traders have to take. But if you do want to carry positions, then carry options, carry call options over the weekend, and then see what happens. I would be a buyer.
All right, you would be a buyer. That's the point. Individual stocks, what do you like?
Well, it's mainly a buy list. My only intraday short is Escorts. Sell with a stop under 29.81. Marico is a buy with a stop under 577. HDFC Bank is a buying opportunity. That stock, once it takes off, should do very well whenever it does that. HDFC Bank is a buy with a stop under 1677. And another FMCG, Dabur, is a buying opportunity with a stop under 489.
Right. Mitesh, your stock picks?
I have all my calls as well. On the list is a buy on Adani Green with a stop at 837 for targets of 885. Then Reliance is a buy with a stop at 1243 for targets of 1286. HDFC Life is a buy with a stop at 625 for targets of 650. And sorry, one sell call, that's Ramco Cements. Keep a stop at 842, look for targets of around 800.
Got it, gentlemen. Thanks a lot for joining. We'll come back for the 9:10 call. For the time being, though, we slip into a short break. We'll be back with pre-open rates. We'll also be joined by Mr. Vishal Manchanda of Systematics Group to talk about the key trends in the pharma sector. You stay with us.
Well, roughly 16 minutes away from the open. You're watching us here on Open Exchange live from the CNBC-TV18 Motilal Oswal studio and Bazaar morning call. We have about 2 minutes to go for pre-open as well. The GIFT Nifty indicating a mild positive start. So let's get in a view from Deepan once again before we move forward with the show. Deepan, in the pharmaceutical pack, you said that large cap IT not particularly looking very good, mid cap IT either. Banks, you're selectively constructive on, more positive on NBFCs. Where do you stand on pharma?
Yeah, Mangalam, I was very positive on pharma right until Trump came into the presidency. And now there's suddenly a fresh wave of uncertainty because if he starts to put customs duty on pharma imports, then whatever the industry may say, it's certainly going to mar the sentiment within the sector and it's going to impact revenues and profits. So till we don't have certainty around Trump tariff, I would like to avoid pharma for the time being. Also, domestic pharma sales have slowed down. I think the latest numbers showing about low single-digit type of growth rate. So from that point of view, also the fact that pharma has done very well over the past 4 to 6 quarters. I just like to be a bit cautious in the pharma sector. Although long-term prospects are great, but let this uncertainty around tariffs be over and done with before we can take a more positive approach to that sector.
Okay, all right. Let's talk about the big boy, Deepan. What's the view on Reliance Industries? And Jio Financial Services is going to be coming into the Nifty. Bulk of its value is derived from Reliance Industries. And then there is, numerous triggers for that stock. Given that, would you play Jio Financial Services or would you simply play Reliance itself?
No, neither of them, Nigel, because growth rates are slowing down over there also. And frankly, Jio Financial has been able to scale up their core lending operations as well as I think the street and we are expecting. And within the NBFC sector, looking at the risk return profile, the valuation, there are many choices over there. So I would avoid both these companies. And what is happening in Reliance is that gradually that holding company discount is coming in, because now it seems most likely that they will do IPO for the mobile telephony business as well as for the retail business. So then investors may go for these companies rather than Reliance Industries, and we're not great fans of holding companies as well. So from that point of view, I think it's best to avoid Reliance Industries as well as Jio. Great companies, no doubt about it. But from an investment perspective, I think it's just a hold or wait and watch.
What about the consumption space? I mean, even in the macro data, the only thing that did not stand out was, or rather did not grow as others, was the consumer non-durables, which implies consumer staples itself. Are there signs of any recovery? Is there sign of any sort of value purchase or maybe protect your capital in the consumer staples?
Mangalam, I think FMCG is a sell at every rise. The industry volumes have come off significantly. The MNC FMCG stocks, which have been great wealth creators so far, their volume growth rates are 2 to 4% or so, and that doesn't really impress us. And a lot of categories have also become mature over there. So within the consumption space, you need to expand the spectrum, go more into different sectors like hospitality, aviation, retail, healthcare, entertainment. I think there are many choices over there, consumer durables, many choices over there rather than sticking with FMCG.
Okay.
All right. No, just a final question then. If you had to deploy your money, say 100 rupees, how would you distribute it across sectors? Because you've been positive on financials. You can't put 100 there, right?
4 sectors. Banks and NBFCs, engineering construction companies. I would say third would be to an extent, cement. You may find it surprising that I'm actually recommending cement companies over here, because I think that there could be a trading play over there. And lastly, I think domestic consumption-oriented companies like maybe which are into retail or maybe aviation, hospitality. So these are the 4 sectors where I think investors should deploy most of their portfolio.
In what weights?
Focused. I think cement would be 15%. The rest would be all equal, I guess.
Wow, Dipan, it's been a long while since you liked my cement stocks, but good. Happy to see some optimism. But actually, you've been hinting at that for the last few times we've interacted after, I think, a couple of years where you didn't want to look at metals or cement. Good. Very quick word on IndusInd Bank, because that stock will continue to remain in focus, right? The trust factor has weighed on the stock. But now the argument is that 50,000 crores of market capitalization, where you have a business book of more than 7 lakh crore, as Abhishek has told us, how much more can it fall? And if the promoters are serious about infusing money, that could support as well at the time to come. Your take?
First of all, Nigel, we have been shareholders of IndusInd Bank, and we really feel the pain of such massive underperformance. And normally I don't average, but this time I'm tempted to average just because of the valuation. I think they're so attractive at 7 times or thereabout. But I don't know. I'm just thinking about it and mulling about it. See, whatever problems are there, that's 1 quarter profits. And overall banking industry also is looking up. So, IndusInd Bank, which has been a quality player in the past, may recover lost ground. So just from a valuation perspective, I'm tempted to average, but I haven't made up my mind, and it's just a disclosure that we may be looking at buying the shares, and in any case, we have an investment position in the company.
All right, we take that point. We started with the pharmaceutical space, Dipan. Let's discuss more of that in detail with Vishal Manchanda, who's joining in. Vishal, Dipan said that he was fairly bullish on this space until this Trump-related uncertainty came by. So what are your thoughts on, how much it would impact, and which would be the stocks that would be most impacted by these tariffs? Or do you think that maybe, it's okay, tariffs or not, our manufacturing costs are a lot lower than international manufacturing?
So like we've been discussing this for quite a while, the Trump tariffs. So I think we think it, the way we want to think it, it seems like it'll be difficult for the US to impose tariffs on Indian pharma because it's against their best interest. It'll be inflationary because there is no room for Indian companies to kind of absorb the tariffs and retain the prices that they sell the drugs at. And if US wants to manufacture these drugs in-house, it will be like, I think, at least 2 times costlier, if not less. So at least 2 times costlier for them to manufacture the drugs in-house. And then you can't manufacture them in-house practically because you don't have the ecosystem to do that.
Okay.
So if in case if there are differential tariffs, like if they impose tariff on India and they don't impose tariffs on other countries, even then I would believe there are no capacities available, USFDA approved plants available to meet to the kind of supply that India caters to. So I don't think there's a remote chance here for Indian companies to be hit. But let's see, wait and watch how things pan out.
Uncertainty on what Mr. Trump will do today, tomorrow, or day after. But for the time being, you're saying that's not your, that's not the case. You're factoring in that Indian companies get hit because of these tariffs. Got that. Good to see you, Vishal. After a while, let's focus on a couple of other factors. We saw Sun Pharma. They went ahead and they did some inorganic growth. And this will add a good size, right? It's pretty interesting acquisition. I think most on the street were positive on it. How do you see this fit in? And what is the target price you have on Sun Pharma?
So I think this the drug that they got through the acquisition is called cosibelimab, which is a PD-L1 inhibitor. So this the market opportunity that this class of drugs PD-L1s represent is a very large market opportunity, and specifically for this indication, Sun Pharma has got an existing market presence. The data so far is convincing, and they already have a USFDA approval. So we don't face any regulatory risk. So based on the prevalence data that we have, so it's for a skin cancer indication. I think based on the prevalence data for the indication that they've got approval for, it should at least be a $250 million, assuming only 10% share. There are 2 other players who are competing for market share there. So I think looks like it can be very interesting. Bare minimum $250 million is what I would think, and it can exceed $500 million in peak sales. And they paid about $350 million upfront, plus there are contingent value rights.
Okay. All right. And I think on Sun Pharma, you have a buy rating with a target price of around 2,200 rupees, right?
Yes. Yes.
All right. The other one I wanted to focus on Jubilant Pharma. You have been very, very confident that the management out there is guiding that the revenues could potentially double. They've also been talking about margins moving, I think, from high teens to early 20% odd. Your view on the stock?
So I think there's just one overhang there. Apart from that overhang, if I would look at the story, it's a 15 to 20% compounding story at the EBITDA level, and the net earnings should compound faster than the EBITDA growth. So the only overhang that I see in the near term is the tariffs, because US intends to put tariffs on Canada. So these tariffs were imposed and they were kind of again taken back, and so there's a lot of to and fro happening here. For the moment, the products that Jubilant Pharma manufactures in Canada and sells in the US, they are all exempted right now, but you don't know whether they come under the tariffs again. So if we exclude that, they're placed in a very good macro environment. So they have exposure to sterile contract manufacturing. We know that the sterile contract manufacturing space is facing supply issues, and they have a presence in the US. So that is where most of the demand is coming to. So sterile manufacturing is where innovators don't want to rely on countries outside the US. They want to outsource more to the US manufacturing facilities, and Jubilant is positioned there. Jubilant is also positioned in a market radiopharmaceutical space, which until a few years back was not growing. But if I look at the growth opportunity there, that's going to be like 10 to 15% compounding story. And they're well placed in that market among the key players in that space. So I think a good play.
Vishal, just a quick point on semaglutide and GLP-1, because, globally, it seems like the fad that there was is now slowing down or plateauing, if at all, the growth rates out there. If you could give us a sense on how that is and what that would mean in terms of an opportunity for Indian players.
So I think semaglutide going generics is a separate opportunity, while the overall GLP-1 market is more. So globally, the GLP-1 market is driven by innovators, while in India and emerging markets, we'll see the market being driven by semaglutide generics. So if I look at the picture globally, I think what probably is happening is the patients who take this drug for obesity are not taking it for too long. They tend to kind of get out of the treatment maybe 1 year, 2 years, or 3 years down the line. So currently, if you look at the adherence rate, I think only about 20-25% patient would stick to the treatment 2 years down the line. So there are new patients coming in, the older patients are dropping out of the treatment as far as obesity is concerned. And that's where large part of the expectations are also placed. While coming back to the India opportunity, this is going to be more driven because India is currently not actually, so we don't have adoption of GLP-1s because of the pricing issues. But once generics come in, pricing will come down and we'll see some adoption. And even if we kind of see 3 or 4% adoption, this can be $1 billion market in India.
All right, Vishal, got that. Thank you very much for the perspective. It's been quite helpful. Thank you for joining us today. Well, that's a call on pharma stocks and the pharma space. Let's go back and look at the screen now. Nifty now in the pre-open suggests that we'll start about 71 points higher. And the Midcap index is actually outperforming. Bank Nifty is also in step with the Nifty at this point. So let's go back to our technical experts for some final ideas. Sudarshan, what's the 9-10 call?
Well, you can buy HDFC Bank and keep a stop under 1677.
Okay. And Mitesh, what stock would you go with?
Yeah, I'll go with the buy on Adani Green for targets of 885.
Okay, all right. Well, thanks a lot, gentlemen, for giving us those calls. Well, let's focus on a couple of top stocks then. Tata Steel, that's the one on my radar. JPM, they have written a note on Tata Steel. They have an overweight rating. They have a target price which has been raised to around 180 rupees. Two key factors they're highlighting. One is they see positive catalysts to the earnings growth in Tata Steel Europe business. And also their second point is they're seeing higher investor interest in Tata Steel stock during the meetings that they've had in Hong Kong as well as on Singapore. Focusing on the Europe aspect first, they believe that the potential positive impact from Germany's infra fund news and the sharp rise in the euro steel spreads is not fully appreciated by some investors yet. On the Europe steel spreads, they say that that's up by close to around 18% on a sequential basis and up close to around 60% if you compare it on a spot basis. This comparison they're doing versus the Q3 average. This is likely not incorporated in consensus estimates, and so they believe that Tata's Europe business should reach EBITDA break-even in the first quarter of next fiscal. And because of this, they've gone ahead. They've increased the Europe EBITDA per ton assumptions for the next 2 years. That's FY26 and FY27 to around $68 to around $70 per ton. That compares with earlier, they were in that vicinity of around $20 to around $27 per ton. And the overall FY26 and 27 EBITDA, they've increased it by around 8 to around 11% or thereabouts. So JPM positive on Tata Steel Europe. Let's keep an eye out on that one. Sudarshan joins in though to tell us about a couple of other names. Sudarshan, tell us, Adani Green as well as Dr. Agarwal's Healthcare is on your radar.
So first one is Adani Green. Yesterday we saw JP Morgan moving two of its RG bonds. RG is basically restricted group bonds to overweight from neutral. And today Macquarie has come out with a note on Adani Green initiating coverage with an outperform call, and target is 1200 per share, implying an upside of almost 40% from current levels. It says it's leading India's energy transition, and targeted capacity by FY30 is almost more than 4x from current levels. It's targeting 50 gigawatt capacity by FY30 versus 12 gigawatt capacity now, and conservative pathway implies 25% EBITDA CAGR over next 5 years. It expects company to generate $1.8 billion annual operating cash flow, and despite the high capex that company has, Macquarie believes that net debt to EBITDA will decline to 5x by FY30 versus 7x now. Second one is Dr. Agarwal's Health. Morgan Stanley has initiated coverage with overweight call, and here target is 502, implying an upside of more than 15%. It says eye care industry is high TAM. TAM is total addressable market. Second, high barriers to entry and high returns as it is asset-light model. It believes that company is well positioned to outperform, and revenue at 1.7 times. Revenue is 1.7 times closest to its PI.
Sudarshan, okay, bell's gone, Sudarshan. Sorry to rush you. But we've got a positive opening, 50 points higher on the Nifty. The Midcap index is looking even better with a gain of about 200 points right now. Bank Nifty is up about 0.25%. So banks are leading the charge on the way up for the index. Let's look at what's moving. BEL, 2% higher. BEL's order flow has been very, very smart. They've been announcing orders almost on a daily basis. Market likes that, 2.5% up. IndusInd Bank is seeing some more recovery, 2% higher. ONGC, Tata Steel, Bajaj Finserv, these are some of the names on the upside early on. Now it's about a 35-point gain on the index. Tech is recovering after yesterday's drubbing. So Tech Mahindra, Infosys, these are some stocks that are seeing some early green. TCS is at the flat line, not quite a gain, but just a couple of notches here and there. Then there is some buying that we're seeing in names like Bajaj Finserv, but now it's also a little red. So let's look at the red side. Dr. Reddy is lower, Ultratech Cement is down, couple of FMCG names like Britannia, Lever starting lower, Titan is starting lower, Trent is starting 0.25% lower as well. Kotak Mahindra Bank is slightly soft. The market's turning. Actually, look at the Midcap index. It's suddenly showing a shade of red. Quick, swift turn. Nifty is still trying to hold on to a 30-point gain. It's a volatile start, to say safely.
I think par for the course, right? You get mild green, gets into the red. That's par for the course on the headline index. The breadth of the market is good. You still have 1,400 stocks that are advancing for 500 stocks that are declining, so I like that. A couple of names in the broader markets that are moving higher on high volumes. The MTNL stocks up close to 10%, massive volumes on that one. SCPC, they won a big order yesterday. The stock was up close to 20%. It's up close to around 4% yet again. EIL, that's up close to around 2.5%. So good move is what we're seeing on that particular name. Very, very large volumes as well. BEL won another order. Street likes it. Adani Green, Sudarshan quickly told us about, brokerage update out there that brokerages are fairly positive on the stock, and there's an initiating coverage report as well. So that opens with a gain of around 1.5%, but it already had rallied close to 4% in yesterday's trade. Tata Steel, JP Morgan likes it. The street likes it as well. That stock is up and about in today's trading session. As we speak, the Midcap index is trading more or less flattish, mildly in the red. The Nifty Bank, though, up close to around 75 points. Fairly decent start.
On MTNL, I just want to point out that yesterday there was a reply in Parliament that BSNL and MTNL, they've been selling off their assets, including land, and together both the entities have gotten about 13,000 crores. So that's something the market seems to like.
Well, this has been the long dream, right, for MTNL. The only question is that of this 13,000 crores, how much comes to the shareholders in forms of any sort of dividend or special bonus, or if at all that money does come by or not. Meanwhile, a bunch of stocks which are now picking pace. We have Emphasis, which is now moved to the high point of trade. Avenue Supermarts is starting out well as well. And Balrampur Chini, all of yesterday we were wondering why is it that the stock's moving higher, and now the stock's open lower, so maybe some profit booking on that one as well. And Gensol is another stock that I'll keep an eye out on, down 18% this week, lower circuit right now as well. And today is 13th, which implies that they have that meeting to consider fundraising. So we'll keep an eye out on Gensol out here as well. Carousel, which was up 20% yesterday, seeing some bit of profit taking in today's trading session. A couple of these textile names are buzzing right now. Nitin Spinners, for instance, is up around 3% and moving with a fair amount of volumes as well. Varun Beverages, too, as we move into summer months, maybe some bit of demand expected out there, demand improvement expected out there. That stock up around 1.5%. But good time to welcome in Nilesh Shah, who's the Managing Director and CEO at Envision Capital, joining us now. Nilesh, good morning. Good to see you in. We've seen a drubbing in the markets. We've seen some recovery. Now things look like they're more or less settled, if not, running away still. Though what's not settled is what's taking place in the US. Let's start with the IT. Everyone's been super bearish on IT right now. We've got a couple of brokerage cuts that came by too. And right now, over the overnight when we saw that positivity come back in NASDAQ, that's reflecting in some of our IT stocks. But all said and done, where do you stand?
So, Mangalam, good to be here on the show with you, and good morning to all the viewers. In the very short term, we are going to be correlated with the NASDAQ and the US markets as far as the big IT companies go. But the bigger challenge which IT companies have been facing now for many years is basically a very tepid kind of growth. The growth is pegged to the US GDP, which probably grows at around 2 to 3%, and versus that, they have been growing at about 4 to 5% in dollar terms, and at best, maybe high single-digit growth in terms of the rupee or the local currency. So I think from a growth point of view, there's really no juice in the large cap IT names, the top tier names. Clearly, I think it's more a kind of a PE or a multiple arbitrage that you play in, with about 20 times being the floor and about 30 times being the ceiling. So clearly, I think currently the large cap names are trading currently at 23, 24 times trailing earnings. Probably, I would still think there's a bit of a downside to the large cap IT names. However, having said that, clearly the big opportunity is in the tier 2, tier 3 IT companies. Clearly believe that those companies which will work on developing their own agentic AI solutions will be the big winner for the medium to long term. And I think that's an opportunity which can give them strong double-digit kind of growth over many years. So clearly, that's the space to be focused on. Second is there are a few tier 2 companies which are product companies, enterprise software companies, which have corrected quite meaningfully over the last 2 months. They've corrected probably between 30 to 40%. And valuations have become way more reasonable. And they deserve to trade at a premium to the market or a premium to the large cap IT company. So I clearly believe that's really where the focus of investors should be, and not necessarily basically focus on the top 3 or top 4 companies.
Okay, all right. Hi, Nilesh. Good morning, and always good to see you. Nilesh, first on the market, it's a correction, or are we getting into bear territory? What's your take on the Indian markets?
Well, I would be in the correction camp. I clearly believe there are no strong reasons for India market to be in a bear zone. Corrections of close to about 15 to 20% are pretty much par for the course. Even in a bull market in the past, we have clearly seen markets correct by 15, 20% and then kind of basically rally. I think in the past, whenever these kind of corrections have happened, at that point of time, investors looked upon that as kind of a risk, the way they currently see the current correction, but clearly in hindsight, that becomes an opportunity. I probably think that maybe a few quarters down the line, when we look back, we would think that, wow, what a correction that was, and what an opportunity that presented.
Well, that's right. If hindsight was foresight, we'll all be millionaires, right? But, a lot of investors out there who haven't seen, 15, 20% pullback, they're getting very, very jittery. In fact, it was heartening to see that the SIP book is still intact at around 26,000 crores or thereabouts. So some maturity from investors is definitely, being seen out there. Let's talk about this large versus small cap debate, right? The small caps, the mid caps, they've got hammered, but they had a big party. Do you think pockets are still emerging now where we are seeing some kind of pockets of strength? As you said, I think from the IT pack as well, there is the mid caps that will grow at a faster clip. So for the market construct itself, if you're allocating money, what would it be as of now? Large, mid, small?
I would still think from a medium to long-term perspective, it still has to be the mid and the small cap. The mid and small cap companies are growing at a faster pace versus their large cap peers. They're becoming more capital efficient. The access to markets, their access to capital has kind of improved quite significantly over the last few years, which clearly puts them in a very vantage position. Given their relatively smaller size and being very strong in several niches, gives them basically a strong tailwind of growth. So clearly, the space to be in for medium to long term is the mid and the small cap kind of space. The large caps have been struggling with growth. I mean, whether you look at large cap IT companies, large cap FMCG companies, large cap banks, they have been growing below industry growth. They are the guys who are getting challenged by the challengers. And therefore are essentially kind of have been reporting very tepid growth. So my view is why look at large cap? They can probably give you high single digit return, might as well then be in fixed income rather than because you have the downside of equity and probably just at best the upside of fixed income.
Nilesh, hi, morning. Great to have you on, and holy greetings to you. This is exactly the point that, I was discussing and debating yesterday, because our colleague Rima, she put up a chart on forward earnings projections for IT companies FY26. The numbers were like 3%, 3.5%, 4%, 4.5%. So I was joking, saying you replace all the IT names and put in the FMCG names. It'll be the same chart. It's the numbers haven't changed. And that's the problem with the market, exactly what you're saying, with the large cap side of the market. There's no growth. So then what are you paying for? Anyway, so that's a separate debate. But I want to spend some more time on IT. You've always liked the digital themes a lot. I mean, it's not in this correction. You've been liking them for last, I think, a year and a half or 2 years. In this correction, Nykaa, Paytm, Zomato, Swiggy, PB Fintech, these stocks are down between 30% to, I just checked, 44% on Swiggy. Swiggy is way below its, listing day price as well. With this kind of a value destruction, do you see bargains? And more importantly, do you see some growth safety as well? Because a lot of these companies are still in investment phase. For instance, the quick commerce guys, they're setting up these dark stores. And they've acknowledged that it will pressurize margins, at least in the near term. So what to buy in digital after this market fall?
So we invest. We are holders of probably most of the names that you basically mentioned. So that's the disclaimer here. But clearly, this is honestly an opportunity for many years. Digital essentially is the way forward. And clearly believe that over the next 3 to 5 years, the digital platform companies will keep compounding in double-digit rates. They'll become significantly larger, and many of them, one odd name has made it to the sensex and the nifty. But I probably think that the composition of the sensex and the nifty itself will change over the next 5 to 7 years with many more additions to their names. While each one of them does have competitive intensity or regulatory challenges here and there. But today, look at it. What are the two big risks that this market is facing? One is on the tariff front. Second is on dollar devaluation. On both those risks, digital platforms score high. I mean, they remain relatively insulated from both these risks, and the entire growth opportunity is the domestic space where they have the opportunity to go ahead and keep garnering market share and keep growing at double-digit rates. So I clearly believe that this correction that we have seen of about 30 to 45% in digital platforms or digital companies clearly is not just great from a risk point of view, but is also great from a growth point of view.
Okay, so that's one space you're absolutely convinced about. Before we let you go, any other ideas, solid ideas, where now you're getting a great price entry point and you're seeing reasonable growth ahead? What else, apart from the digital companies?
So apart from the digital companies, I think the consumer product companies, and I'm not talking of the large cap FMCG companies, but maybe again the smaller consumer product companies which have strong, basically niches. I also believe that over the next few years, consumption will remain relatively resilient, especially with the initiatives in the most recent budget and then some of the other direct benefit transfers which state governments are doing to consumers. I think a combination of all of that will leave more spending power with consumers, and a couple of categories which I think will remain standout categories will be the alcobev space, and second is essentially the beauty and personal care segment. So I clearly believe consumer products as a category looks good. Within that, subcategories like alcobev or beauty and personal care could end up being standout categories.
Just quickly on PB Fintech, you own that stock, specifically just asking because of the diversification that they've done. They've deployed capital in PB Healthcare. The street did not like this diversification away from core.
Well, Mangalam, they have been, of course, this is essentially a development which is 6 months old. I think the management has gone on multiple occasions to clarify that the allocation will be no more than $100 million. I think the current allocation pretty much is within that ceiling of $100 million. I also see many other players in this space, hospital companies moving into insurance companies. Here is an insurance distribution company trying to kind of get into healthcare to improve the consumer experience. So I clearly believe that it's honestly not a very material kind of event. Unfortunately, the market sentiment is not really the best right now, and therefore these are probably being looked upon as markets as being some bit of a distraction kind of thing. But I honestly don't think this poses any kind of a structural headwind to their medium to long-term growth plans. And I don't see that as an issue of any serious capital misallocation.
All right, Nilesh, thank you so much for joining in and giving us perspective on a whole lot of things, including specific stocks as well. Wish you a very, very happy Holi and season's greetings as well, you and your team.
Thank you so much. Thank you.
Let's move on. Let's talk about Aster DM Healthcare. The stock is in focus. The promoters have cut their share pledge from 99% to 41% upon completion of refinancing of the debt. What does this mean for the company? What are the growth prospects looking like? All of that we discuss. Alisha Mupin, who's the Deputy Managing Director at Aster DM Healthcare, joins us now. Good morning, Alisha. Wish you a very happy Holi. Just a word on the pledge itself. It's down from 99% to 41%. The obvious question, when does it reduce further? What's the plan for that? And secondly, what is the debt on your books right now? You've refinanced a lot of the promoter debt. What's your cost of finance?
Good morning. Happy Holi to you too. So we're really happy actually, Mangalam, that we have managed to sort of reduce the pledge significantly. Of course, like you said, it's gone down from 99% to 41%. This was kind of needed at the time of the GCC transaction when we were selling, and it was just a bridge loan that required us to sort of take a large pledge. And because of technical reasons, even though we had kind of repaid a big part of the loan at that point, we could not reduce the pledge. So this refinancing with JP Morgan, HSBC, Barclays has actually allowed us to sort of significantly change the financial encumbrance, the LTV, all of that. So feeling, much better position for the family and for the company as well as we look forward to the future. And of course, as you're aware, there's a big growth prospect.
Right. But we understand that, but that still doesn't answer our question. What happens to the remaining 41%? When does that get depledged? And the refinancing, I mean, what rate it has been done at? What is the promoter's leverage right now?
Yeah, so the refinancing is being done at a very similar sort of 6% plus SOFR and stuff. So it's very competitive to what it was earlier. I think the bigger question that you're asking us, when does it reduce further, right? So we do believe that the merger is actually going to be a big part of us over the course of the next 1 year, further reducing it. So I think it kind of goes a bit hand in hand. So the goal is to reduce it significantly over the course of the next 12 to 24 months.
Alisha, just to kind of close in on that point in terms of promoter ownership and pledging, can you tell us if promoters are comfortable with their current shareholdings? Would you look to add to it? Or at any point in time, is there still that plan of gradually letting go of a little bit of the company?
No, so to be honest, we never kind of reduce our shareholding in terms of stake sale. It's been more reduction of shareholding because of the expansion that has happened.
The merger.
The merger, exactly. Yeah. So we are very positive and confident about sort of the growth prospects for Aster. So we don't think that, we don't have any plans, to be honest, of disposing of any or reducing our shares any further.
Okay, all right. Hi, Alisha. Good to see you in, and thanks a lot for joining in here on CNBC TV18. Let's get two aspects out of the way. One is with regard to the merger. As of now, you're doing margins in that vicinity of around 19%. But you have plans that are going to take it up, I think, to closer to mid-20s. So what are the triggers in place for that? Point number one. And also point number two, your average revenue per bed, that's been nicely moving up. Where do you see that number stabilizing at?
Yeah, so the margin, like you said, actually, so the margin expansion, we are expecting this to be in the mid-20s. We think the revenue growth over the next medium term, 2-3 years, we will see it growing in the late teens. When it comes to the margin expansion, definitely we believe that the synergies with the merger will also help us kind of improve the margin further with the consolidation happening. So quite confident that we should be able to get to a 20-25% over a medium term, 3 to 5 years. On the RPOP, I think now there has been like a good CAGR growth of around 7 to 9% that we've seen in the last few years. And again, a combination of sort of the clinical work we're doing, right? I mean, if you just look at the sort of the number of transplants that we do 50 transplants a month. We do 500 robotic surgeries every quarter. So definitely there's RPOP growth that comes from that as well. So we see, assuming sort of a 7 to 8% RPOP growth to also come in, which we believe is comfortable considering the regions that we operate in.
Okay, to close the loop on the merger, by when does this merger take shape and the synergy benefits start flowing in?
I think we're still sort of talking about the merger to conclude in sort of by the end of this year or the beginning of next year, right? So I think Q4 probably is a likelihood, and that's when I think we'll start seeing sort of the benefits slowly trickle in by early FY26.
All right, benefits come in from early FY26, 7 to 8% average revenue per occupied bed growth, late teens sort of revenue growth that you're anticipating, along with margins at around mid-20s as well. That's about, business as it is right now. Just a couple of things that are taking place. In Kerala, there's one big competitor which is entering with around 3,000 beds in the next few years or so. in the western part of the country as well. We had Adani's announced that they might, look at entering this space with a big hospital too. So on competition, what's your view? I mean, do you think there is enough space for everyone to sustain growth at the pace at which they are growing right now with the margins? Or may you, look at some sort of consolidation as well? What if the Adanis write a good enough check? Would Aster DM be willing to sell some of their hospitals?
We honestly think competition is always good. It just sort of improves the kind of the entire industry, and the demand supply requirements across the country is still significant, right? So in Kerala, definitely we have a clear market leadership, and even with the merger, the consolidation that happens in Trivandrum for us with the KIMS asset will just make us clearly number one by miles. So definitely competition will just help kind of further improve and attract better talent. So we're not really worried. In terms of Adani's getting in and others, we do think that, this is how the market has been. We've been operating now in Bangalore for the last 10 years. Every player is there. It just makes the market even better, to be honest, in terms of outcomes, in terms of margins, everything.
But there are opportunities. Are y'all on the, are y'all of the belief that maybe y'all can exit if the price is good enough?
No.
Not Adani's, but just generally.
Yeah, no, not at all. I mean, as a family, we're fully committed to sort of staying here for the long term. No, absolutely not. But always looking at strategic, options to sort of strengthen the company, right? And that's what we did with the demerger and now with the merger with QSIL as well.
All right, final question before we let you go. We have had Dr. Mopin as well joining in here in the studio and giving us his vision as well. Could you tell us currently what is the total capacity that you have in terms of beds, and you have a addition plan? So say in the next 3 years or so, what should the company's bed capacity look like?
So we are, as Aster, close to 5,000 beds right now, and we've got sort of a capacity expansion of another 2,000, 2,500 beds that's in the pipeline. And to be honest, the QSIL capacity is also very similar. So what we are seeing in the next 3 to 4 years is a 14,000 bed capacity that will be seen once and when the merger goes through. So we do have a very significant size, right? So I think integrating these platforms is going to be the most exciting thing for us, and I think that's what will unlock a lot of value for the shareholders as well as for our patient and customers as well.
All right, Alicia, we'll leave it on that note. Thank you very much for joining in, and good luck with all of those plans and all the expansion that you have lined up as well. Thank you for joining in. We do have to take a very quick break. Market's absolutely flat. Midcap index is down about 0.3%. We come back full throttle after this break and talk about the entire IndusInd Bank issue and the larger questions that it's throwing up with respect to accounting for derivatives and, what are the lessons for shareholders? And more importantly, can confidence come back? Karan Gupta of India Ratings and Abhizar Divanji of Neostrat Advisors join in. Welcome back. So it's, around the flat line, largely for the indices. Let's quickly pull them up, Nifty as well as the Midcap index. That's the kind of morning. Quiet as she goes. That's what's going on. But we have that sort of larger issue to discuss. Like I said, it's all about IndusInd Bank. The stock, of course, saw some recovery yesterday. There was some buying early in the morning as well. Yeah, it's still up about 1% or so. But questions still remain after what was a massive 27% drop. And I think, a wipeout on that day for almost 20,000 crores in market cap, and all because the bank disclosed discrepancies in its derivative portfolio. Now, the bank's management obviously told us that this is a one-off instance, and they're sort of very, very clear on disclosures and corporate governance norms. But we also understand, actually, from our colleagues in Money Control, that perhaps this is something that will get the RBI to open up a much wider review, should I use the term. Yeah, we've got those graphics up. That's what Money Control is reporting, that the RBI is now opening up a wider review of all other banks, private as well as PSU, to look at how banks are, looking at their derivative accounting, their trading books, and if there are any other discrepancies anywhere else. Let's talk about this. Karan Gupta, Director and Head of Financial Institutions at India Ratings, is joining in. And we also have Abhizir Devanji, founder at Neostrat Advisors, both experts in the financial arena. Thank you very much, gentlemen. So I'll come to what our sister concern Money Control is reporting in just a bit about a wider review and how you account for derivatives. But first, on IndusInd, Abhizir, massive, hit to sentiment, to confidence, really. And I think the market's entire issue was that if you knew this way back in October and you decided that there are some discrepancies and you need an external review, why didn't you disclose? Why didn't you tell the market? What are your thoughts on the way the whole saga played out and the CEO's explanation, which I'm sure you would have heard?
Yeah, so to be very frankly, why did it not come out earlier? I guess it's the bank would have best known why they did not do it. But very clearly, what would be also the case is that before you actually come to the markets, they would actually want to make sure that they know exactly, they've sized up the problem well and they've understood it well. That could have been a very big concern. And derivatives, frankly, as a accounting class, or even as understanding what derivatives are about, actually is a very complex arena. So in my view, maybe the delay is because they were trying to size up what the issue was and whether it was prevalent, whether it was only a one-off incident, whatever. And as and when the bank would have got some level of comfort, they would have actually, come back to the investors. By the way, RBI would have obviously been informed much earlier. So it's not that the issue was completely hidden and within wraps within the bank. I'm sure consultations with the SSM would have been live as the issue would have been discovered.
But I guess delaying that disclosure to 5-6 months later, saying we'll tell the market when we have better clarity, that doesn't really help, right? It anyway damaged sentiment. It damaged, obviously, your market valuation as well, investor wealth as well. But, the bigger issue is understanding what is this accounting discrepancy. Let me bring in Karan as well. Abhizir, I'll come back to you, because what Mr. Katpalia told us was that there is apparently this internal desk and there's an external desk, and one desk did not account for the loss and the other didn't account for the gain, or something of that sort. Like you're saying, it's very complex. Karan, can you tell us a little more about the accounting methodology right now and what you understood out of this discrepancy that perhaps IndusInd, in this specific case, is speaking about?
So, what they've highlighted is that the internal desk, or some part of their foreign currency borrowings, as well as deposits that they had, and they held hedges against that, which were not disclosed earlier and have now been disclosed to the market. So that's where it stands at the moment. We are also having discussions with them where we will get to know about things in greater detail, but that's where it is at the moment.
Abhizir, come in on this internal desk, external desk, one not counting for the loss. I mean, at the end of the day, it's 2,000 crores. It's not like, 1-2 crores here and there. It's 2,000 crores we're talking about. How does this happen?
So let me explain what happens generic. Obviously, IndusInd, I am not part of the investigating agency, so I don't know. Yeah. But actually, I can tell you what happens normally in banks. So banks normally follow some kind of a siloed approach in everything. So they kind of distribute risk differently. So what they do is, there is an external deposit sourcing mechanism, which will source a deposit. Then they would designate it internally as a hedge. So they would say, okay, this is a hedge transaction. I'm going to hedge it. So internally, they would transfer it to the Treasury desk internally by assigning certain, so they would do a swap. So
and this is a foreign, Abhizir, just to understand, and what we're talking about, this is an external deposit. It's a foreign currency deposit that a bank gets.
Yes, it's a foreign currency external deposit. That's the external leg from the deposit sourcing side. Then internally, they do a synthetic hedge to say that I will offer this to my treasury at this particular rate. And when they do the synthetic hedge, they record that hedge as a accrual accounting. So what it really does, it says, okay, the whole transaction is hedged. I am not exposed to any risk, either currency or interest rate risk. Right? So the deposit taking department is not exposed to the hedge. And what they then do is that they size up what is the loss, because clearly there is a loss. if you're sourcing a yen deposit which is cheaper, there'll be obviously a cost of acquiring that deposit. So that is accrual accounted over the period of the hedge. So it just says, okay, if my loss is 100 and the period is 10 years, I'll divide by 10 and I'll record 10, amortize 10 over 10 years.
So in
then
this case, synthetic...
This is synthetic, internal in the bank. Internal in the bank.
Yeah.
Then what happens is that the Treasury desk takes that exposure on its books and tries to hedge it in the market.
Okay.
So they actually get hedges in the market. Now what happens is the internal is based on certain benchmarks that they have devised, the bank has devised themselves. The external reality may be a little different. So actually there is no perfect hedge between what has been externally sourced and what is externally hedged.
Okay.
Now, because accrual accounting happens in the internal book and the mark to market happens in the external book.
Okay.
There is clearly a gap.
Okay.
Where as long as you're making money, there is no problem. But when you unwind that transaction, when a deposit gets prematurely withdrawn, for example, that is when the loss is highlighted because the accrual accounting that is done internally doesn't match with the mark to market, which is done
mark to market. Got it. Got it. And that's
results in the larger loss.
Got it. Now we've understood, what the issue was. The question is whether this is just a, one-off, freak miss, or whether perhaps other banks are also missing these gaps, especially in times of high currency volatility. Karan, what's your sense on this? Because this seems to be a wider review that the RBI has now launched.
So, when incidents like this come to the fore, what RBI would do is it would initiate a kind of a thematic audit whereby, they will go ahead and ask all banks to provide data to give them comfort that nothing of this, similar has been left out in terms of disclosures to the market. I think that's the way this is progressing at the moment. And RBI is likely to reach out to other banks as well and get those get that data in place.
Bazaar, what's your sense? I mean, you've seen the sector for decades. Could there be risks of other such gaps or forgotten loss declarations showing up in other banks as well? Or could this be just a one institution specific instant?
So from an accounting and reporting perspective, I can tell you derivatives is the least understood. By the regulator as well as the market, very frankly. So in my view, could there be other issues that may come up in other banks as well as this bank? It's quite possible. Because the RBI came out in the 2024 circular precisely because of the gap that they identified. And they said that, listen, this is not working because the internal transfer pricing is not matching with the external hedge. And hence they said that you cannot have any open positions at all and you need to hedge everything in the market. When the circular came out, even IndusInd started investigating their books. So ideally, when every bank will start investigating their books, they may find these gaps. How large those gaps are will clearly depend on positions taken by the respective banks. But I think now there is going to be a lot more awareness of how treasuries function. So, I worked in a treasury before, and really what the rule, especially in foreign banks, is in their international operations, is that you simply go and hedge everything back to back. That's it. Don't worry about an internal book or an external book. You simply go and hedge every exposure that the bank is taking.
And wherever there's a loss, let it clearly show up and communicate. Yeah, communicate it to the to the
if it's an equal and opposite between the internal and external book, the loss will get recognized and the gain will get recognized.
Okay.
I think that is how. So RBI will clearly want this to be investigated. I don't know whether RBI will have the skill sets to do it, but very clearly there is a skill set gap in the market itself to assess how this is to be done.
Oh, okay. Karan, now in light of these fresh developments and what both you gentlemen are saying that this could be evident maybe in other banks as well, because now the review is on. So now we'll figure out, where the gaps are and what's going on. Does this open up a brand new regulatory risk? The market thought it's all fine. I mean, we were completely okay from a liquidity standpoint, from a rate standpoint, rate cuts happening, asset quality was fine. There was nothing else in terms of a fresh risk. Is this one now for the financial sector?
So see, when we are talking about banks, right, the narrative around the sector has completely changed over the last few years. We are no longer in a position where we are complaining about, the sector being in need of capital, or the asset quality being under pressure, or even the profitability, not being up to the mark. So this, at the moment, has to be taken as a one-off, we'll have to wait to see what the review brings out in terms of if other banks are also going to be impacted by this. But at the moment, I don't think one needs to paint the whole sector with the same brush. That's where I would leave it.
Bazaar, your thoughts? Investors these days in a falling market, everybody will come and tell you, go buy banks. Everything's fine there. But now, what about this? What would your advice be?
I don't think the banking sector is at risk, nor are banks at risk, including the one.
No, not at risk. I didn't mean at risk. I'm just saying a new unknown, and the market always dislikes new unknowns, unpredicted.
So really what's happened is, and I think I agree with Karan, that this risk is something that will have to be measured, and I don't think it may be all pervasive in banks. But what is happening is the external environment is changing aggressively. As countries turn protectionist and as tariffs happen and those kind of things are happening, you will find exchange rate volatility to be there, interest rate volatility to be there. And the banks will have to learn to manage them more dynamically than they would otherwise be doing. So clearly that will result in a new risk in terms of the banking sector, because until now exchange rates have been moving north, may not necessarily happen going forward.
No, got it. So
it has to be controlled.
Absolutely, and this is a new X factor, so to speak, that's kind of crept up. Just a final word, with Vishal as well. With Karan as well. Karan, X of this issue, which is a completely new one. Just leave us with your broad forecast in terms of credit uptake, in terms of the peak of the asset quality stress, credit costs as we are entering FY26. Just remind us of your overall projections.
So in terms of the overall projections for the banking system, we are forecasting about 13.5% year-over-year loan growth for FY26, and deposit growth also should be in the region of about 12.5%, which means that the gap that one was seeing over the last few years between credit and deposit growth, which led to the LDRs increasing, that is going to get minimized over the near future. However, the picture for NBFCs is slightly different. Therein, we are more mindful about the credit costs increasing because of certain asset quality pressures that we've been seeing in asset classes like unsecured business loans, MFIs, and to some extent, even personal loans as well.
Okay. All right, Karan and Bazaar, thank you very much. Very helpful perspective. And I think at the end of this conversation, what we do know is that investors need to strap up for maybe some more uncertainty on this whole derivative issue. It might not be restricted to just IndusInd Bank alone. Let's see what the next couple of weeks and months bring. Well, with that, folks, back to the markets.
Well, that's right. Let's focus on a couple of names then, a couple of stocks on the move. Sudarshan's here to tell us about Muthoot Finance. Sudarshan, stock is under pressure. There's something on the BSE, right? Tell us more.
So Muthoot Finance had yesterday disclosed to exchanges regarding a fraud. That fraud amount is very small. It's of rupees 12 crore, but nevertheless, it's a fraud. And that's the reason you're seeing a downtick in trade. Currently, it's down almost more than 1%. At one point, it was down more than 2%. And it was informed by Muthoot Insurance Brokers that fraud was done by its CEO of Muthoot Insurance Broker, an ex-employee of Muthoot Finance. And now this fraud is related to the gift rewards that basically these people receive from insurance companies. And it was done in the period April 2023 to November 2024. So despite the amount being less and company Muthoot Finance saying that there is no financial impact, you are seeing a downtick in Muthoot Finance stock.
Indeed, it's not the amount, but the move that it is causing the worry out there. But just keep an eye out on a couple of other stocks as well. BB Fintech, after a big drubbing that it saw yesterday, is down about 4.5% today as well. Opened mildly in the green, and that was quickly sold into the stock, down about 5.5% from today's highs. So from yesterday, the stock has seen a correction of almost 7-8%. And the reason why that has happened is because the company is allocating funds towards getting into the healthcare space. The street believes that maybe this could be, there could be better use of that capital, though we did speak with Nilesh Shah, and he believes that there is no case of misallocation of capital. Where this settles is something that we'll keep an eye out on. And we continue to see weakness in the cement names as well, particularly the South ones. But let's get in Mitesh Thakkar now. Mitesh, your trade's at 10?
Yeah. So good morning again. I think the market has been very subdued and quiet, but still looking at some kind of positive traction, at least on the Adani Group stocks. That's where I think these stocks are doing well. So we would recommend a buy on ATGL. I think that's transmission and gas stock. Buy here with a stop at about 600 for targets of 645 to begin with, and eventually hope that we might get higher levels. And on the second stock which I have is a sell on Axis Bank with a stop at about 1022 for targets of 980.
Okay, all right. Got that. Thanks a lot, Mitesh, for that. Well, let's focus on an inward-facing sector or the economic-facing sector. That's the cement space. Yesterday, we had the Tamil Nadu government that had imposed royalty on mined limestone, which made the street a little bit nervous on a couple of names. But JK Lakshmi Cement, well, that's the stock on our radar. We want to ask them, how is demand shaping up and what's the path ahead? Well, to help us out with that, we have Mr. Arun Shukla, the President and Director at JK Lakshmi Cement. Hi, Mr. Shukla. Good morning and thanks a lot for joining in. Well, there's a brokerage positive note as well coming from HDFC Securities. But before we get to those points, let's talk about the industry first. Is demand as strong as expected? We understand that the government is spending more. That's reflected in demand on ground. And what about the real estate space? Housing sector demand is as strong as expected?
I think demand is improving after quarter two being very sluggish. Quarter two onward, quarter three onwards, things have improving. And quarter four has been very good. I think this is as per the expected demand level. And of course, I think all those, budgetary allocation, infrastructure segment, and even income tax relaxation to middle class, that is helping us to drive demand at the ground.
Okay, so quarter four is good. So for if you compare quarter four with quarter four of last year, what's the growth like? Because it will be on a higher base. That it was before elections. There was a lot of money being pumped in. So what kind of growth for your company can you do quarter four versus quarter four last year?
So January, March typically is high. You are right that base is high, hence growth is going to be about industry growth 7 to 8% in quarter four, and we are going to grow in alignment with the industry.
Got it. Great. HDFC Securities, they have pointed out in a note that for this year it will be a very flattish number for you in terms of volume growth, but they are saying the next 2 years you will grow by at least 9%. You concur?
Yeah. So I think if you look at industry overall is going to grow at a rate of about 4.5-5% this year, right? And we are going to grow at about, let's say about 3.5%, which is more or less in alignment with the industry, because industry has also not done so well. Now, going forward, yes, we do have a very, strong conviction that we are going to grow at a rate of, 9% plus, which is going to be little higher than the industry growth in coming years. And more so because, the kind of, growth plan which we have set up for ourselves, that is going to drive volume and, of course, top line for JK Lakshmi.
Okay, so this year maybe you will grow in line to a little lower than the industry, but the next year you're confident that you will outgrow. So 9% volume growth, we got that out of the way. Tell us about pricing, Mr. Shukla. What's happening there? That's been the biggest problem, right? Many times you're increasing prices, the street is not accepting it, your demand is fairly good, but still the buyers are not accepting it. If I compare pricing on an average for quarter four in comparison to quarter three, what is the change? And also if you could help us out with your premium segment as a percentage of your sales, what is it?
Yeah, so coming to prices, I think, prices have not been good this year, and that started from quarter two this year because of sluggish demand. Now, since demand is improving, I hope that prices are also going to enhance in alignment with that. And definitely, I think quarter four is going to be a little better than quarter three in terms of pricing. My estimation is industry, pricing growth or the realization improvement would be about 1.5% per share. And I think JK Lakshmi also is going to be in alignment with that. So this is, I think, part one of your question, right? And second, we talked about premium. Yes, I think perhaps I'm really happy to let you know that we are one of the companies where premium segment is doing very well. Our premium segment out of our total trade sale is about 25%. And our plan is to take it to 30% going forward. We have been doing quite well in premium segment, and going forward also, I think we are hopeful that our the kind of product and value proposition we have, we are going to grow better than all other peer group.
Okay, two numbers, sir, if you can give us. You'll have an ambitious plan that you're going to be taking your capacity from around this 20 to around 30 million tons, and you'll have that on the drawing board by 2030. So in the near term first, EBITDA for this year will be in the vicinity of around 600 to around 700 rupees, maybe around 650 on an average for the full year. But you have a note coming in from a brokerage like HDFC Securities. They are saying that that number is going to go up by around 200 rupees. So for FY26, FY27, you should be in the vicinity of around 850 to 950 rupees. Do you agree that EBITDA per ton will improve by around 200 rupees in the next year in comparison to this year? Point number one. Point number two is, expanding is great. What about net debt?
Yeah, so coming to your first point, yes, EBITDA, I think we have been doing quite a bit around this, efficiency improvement with manufacturing costs. We are one of the best, cement cost producer in India. We have been working on supply chain efficiency using digital and technology, which we have been doing for the last more than 1 year now. And also we have been working on, top line efficiency, like premium product we talked about. We are also working on, improving our price positioning. Just to let you know, in the recent past, just about 2 months back, we have launched our, green product called, JK Lakshmi Green Plus Cement. This is, towards our, effort to enhance our price.
Yes, Mr. Shukla, we have that release. That's a good initiative, and as you said, demand is fairly good out there. EBITDA number improves by 200 rupees in the next year in comparison to this year?
That's what I was coming to, your question. Like, all those initiatives on manufacturing costs, on supply chain, on top line, and, renewable energy, this is all definitely going to take us our EBITDA upwards towards, 200 to 250 rupees for sure.
Okay, all right. Well, a little bit short on time, sir, but thanks a lot for joining and giving us those details. And for the time being, you don't have exposure to Tamil Nadu, so you're saved from this, this royalty hike, but we'll have to see whether other states implement that as well. Thanks a lot for joining in. Well, for the time being, slip into a short break. Come back. Manish Gupta will be joining in to focus on the commodity space. Stay tuned.
Markets picked up pace now. 22,540 is where the Nifty is at, and it's being led by a couple of these FMCG names. So Britannia has moved to the high point of trade. We're seeing some traction in ITC as well. And at the same time, we saw some purchase in names like Titan and Divi's Lab too. Speaking about Titan, speaking about gold, speaking about silver, let's go across to Manisha, who joins in with all things commodities. Manisha.
Thank you for that. When you look at the overnight markets, we saw gold gain, we saw silver prices gain, and we saw most of the metal prices gain quite strongly as well. Well, to begin with, it is about the US dollar index, which is trading at a 5-month lows, which clearly has been supportive. And as you can see on the screen, we're trading at multi-month highs for many of them. The best of the gains clearly continuing for copper and aluminum, where we are trading near 9-month highs. And then you have zinc at 2-month highs, 13-week highs on lead, 1-month highs on steel, and a couple of month highs is how the iron ore prices also are trading with. It all has to mostly do with tariffs, where we have seen 25% of tariffs now on all US imports of steel and aluminum. And that tells you on how much US really imports. So all the trading partners or allies, that is, the numbers are quite huge when it comes to the neighboring allies for US there. So when you look at Canada, 23% of imports that US does in sense of steel comes in from Canada, 16% from Brazil, and then Mexico is quite an interesting ally there as well. And I have a similar chart when it comes to aluminum as well, where you will see that much of those imports that US does come in from Canada. 58% of overall imports do come in from there. Well, interestingly, when it comes to China, which is going to be an important number to watch out for, while we already have 20% of tariffs on China, add to that more 25% as well. And many of these metals could actually be looking at 45% of import tariffs when it comes to steel and aluminum. I want to move on and talk also about metal prices, and that is the most interesting of charts really, because there are two major markets that you follow when you're looking at metals. One is China, London, and then it is about US.
And when you look at all of those prices, you will see that the US metal prices have surged way more higher than what the metals really have done in London and China. So when you have the copper prices, they've gained 10% on LME, but they're up 21% in the US markets there. Aluminum has gained 6% on LME, but is up 15% in the US markets. And steel, these are the Chinese prices. They are down 2.5% in China, but we have seen 31% of increase in steel prices in the US markets in this year until now. So as you can see, there is big disparity in the international markets when it comes to the metal prices.
All right, Manisha, thank you so much for that. And finally, let's talk about some other movers as well. We are seeing some traction in the markets, but what we'll do is actually take the short break, come back on the other side. We have Lata joining in with a special Indianomics segment where she will be in conversation with the former RBI Governor D. Subbarao to talk about inflation data, the Trump tariff impact, and all things macro.